Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the corporate jungle and sometimes uncover a few hidden treasures or maybe just a whole lot of debt. Today we are diving into a report from Greystone Housing Impact Investors LP, that's Guy, it's a Form 8, which usually means something important and immediate has happened. And boy did something happen. We are talking about a significant new loan agreement that's going to shape how they do business. Before we dive in, if you like getting these unfiltered looks into company dealings, hit that subscribe button and join our Discord community. The link is in the description below. So what's the big news? Greystone Housing Impact Investors LP, through several of its subsidiaries, has secured a loan agreement, and it's a big one. We're talking up to $84 million. This loan is set to fund the acquisition of multi-family residential properties. Think apartment buildings, the kind people live in. The report is dated the 31st of December 2025, which is when things kicked off. This isn't just a simple loan though. It's structured with an administrative agent, a sole lead arranger, and a sole bookrunner, all from Bank United. Now, they also issued a promissory note for an initial $42 million. This means they've already drawn down half of the potential loan amount. The proceeds from this initial note were used to buy two apartment complexes in South Carolina called the Park at Sondrio Apartments and the Park at Vietti Apartments. These properties have a history. They were previously owned by a non-profit and used as collateral for bond investments. After a rehabilitation, they were supposed to become rent. Restricted affordable housing, but the operating results were not good enough to meet the terms of the bond documents. This led to problems, and Greystone ended up acquiring them through a deed in lieu of foreclosure on the 2nd of January 2026. So they're stepping in to take over properties that were in a bit of trouble. Now, what backs up this massive loan? It's quite extensive. It includes ownership interests in the borrower entities, mortgages on the current and any future properties acquired with the loan money, and any swap agreements to hedge against interest rate changes. So, if things go south, Bank United has a lot of ways to try and get its money back. Let's talk about the cost of this money. The interest rate is tied to something called 1-month term SOFR plus an additional 2.75%. This rate will change every month, which means their interest payments won't be fixed. If interest rates go up, their payments go up, and if TIRE is a default, the interest rate can jump up by another 5% or to the maximum allowed by law, whichever is less. Ouch. They also have to enter into agreements to manage this floating interest rate risk, essentially locking in a rate through what are called swap agreements. The initial loan is due back in December of 2027, but trees a chance to extend it for another year until December 2028. But this extension isn't automatic. They'll need to pay a fee, make sure their swap agreements are extended, and more importantly, meet certain financial performance targets, like maintaining specific debt service coverage and loan to value ratios. This loan comes with a whole laundry list of rules, or covenants. They have to maintain their legal existence, pay their taxes, keep the properties in good shape, get approval for any major changes to the collateral, and even manage hazardous substances on the property. They also can't just change their name or where they do business without telling the bank, and it gets even more restrictive. They're generally not allowed to buy more property, change their business scope, cancel debt, or enter into deals with affiliates unless it's in the normal course of business, and they tell the bank. They also can't take on any other debt besides this loan and regular trade payables. And the financial requirements are tight. They need to show a debt service coverage ratio of at least 1.00 for every $1.00 of debt by the end of 2026 and 1.10 by the middle of 2027. If they miss these targets, they have to quickly come up with a solution, like making a partial loan prepayment, posting cash as extra collateral, or providing a letter of credit. This shows the bank is really focused on making sure these properties generate enough income to cover their loan payments. Beyond the covenants, they have serious reporting duties. They need to immediately inform the bank about any lawsuits or government actions that could hurt them financially. And they have to provide financial statements regularly, annually within 75 days of the end of their fiscal year. They need to send in full financial statements along with a certificate confirming everything is accurate and that there are no defaults. Quarterly, within 60 days of the end of each quarter, they need to submit those statements too. Now, here is where it gets really interesting. The parent company, Greystone Housing Impact Investors LP itself, has stepped in with a guarantee. This means if the borrowing subsidiaries can't pay, the parent company is on the hook for all of it. No exceptions. This is a strong signal that the parent company has quite a bit of faith in this deal, or frankly, feels it has to support its subsidiaries. This guarantee is serious business. It remains in effect even if there is a foreclosure or similar action. The parent company also has its own financial reporting requirements under this guarantee, including providing its 10K and 10Q reports. They also need to keep a certain amount of ready cash. At the end of each quarter, they must have at least $6.25 million in liquid assets, and potentially $7.5 million if the bank asks for it, and they need to maintain a net worth of at least $200 million. TRE is also a second guarantor, Greystone Select Incorporated, or GSI. This affiliate is guaranteeing a portion of the loan, specifically $8.4 million, which gets smaller as the loan principal is paid down. GSI also has its own set of financial obligations, including maintaining significant liquidity, a healthy net worth, and a specific leverage ratio. An interesting point here is that the bank can't go after GSI immediately if there is a default. They have to try and recover from the main borrower for at least 102 days first. This gives GSI a bit of a buffer. So what does all this mean? Greystone Housing Impact Investors LP is taking on significant debt to acquire apartment buildings. These properties had some issues, so Greystone is stepping in to stabilize them. The loan terms are strict, requiring strong financial performance and adherence to many rules. The fact that both the parent company and an affiliate have issued guarantees shows the bank wants maximum security. This deal is crucial for their strategy of acquiring and managing these types of properties. The risks are clear. If the properties don't perform as expected, or if interest rates spike, they could face serious financial strain. The extensive covenants mean they have very little room to maneuver without the bank's approval. However, the structure with multiple guarantors and collateral suggests they are serious about making this work. Looking at this, Greystone Housing Impact Investors LP is clearly committed to expanding its real estate portfolio. Particularly in affordable housing, this loan is a major move, but it comes with a high degree of financial oversight from the lender. The success of this strategy will heavily depend on their ability to manage these properties effectively and meet the strict financial obligations tied to this large loan. Alright, that's our deep dive into this 8K filing. What's your take on this massive loan and the company's commitment to these properties? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate insights. And don't forget to check out our Discord community for more discussions. Thanks for watching. See you next time.